Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Seb Wallace from Triple Point Ventures to talk about the Triple Point Venture VCT. Hello, Seb.
Hi Alex, how are you doing?
Yeah, very good, and welcome back to
Thanks,
the studio. Firstly, just tell us about the Triple Point VCT and what it aims to do for investors.
Triple Point's VCT began 2018, now on the seventh offer. It's focused on delivering NAV total return, as other VCTs are, including a steady stream of dividends. Does it in a slightly different way to other VCTs, or at least most of them. It goes slightly earlier in its investment approach. It invests in businesses at what we call the seed stage predominantly, although generally speaking, pre-Series A. And really looking to see NAV growth pull through over time in each individual portfolio company. Very granular portfolio, 50 companies in 68 million of AUM. I think actually on a per £1 million of AUM basis, the VCT is the most granular of its age, and really trying to deliver the outcome that clients want, done in a slightly different way to many others.
Okay, that's great. Now, tell us also a bit about Triple Point and about your own career there.
Yeah, Triple Point's been around since 2004. It was very early in the VCT game. In fact, actually the first product that Triple Point offered was a VCT. It's now expanded. It's now £3 billion overall, managed by the group across five strategies. One of those, which we're here to talk about today, is venture. Me and two other gents, we co-founded the ventures business back in 2017, started with an EIS and now have the VCT. I run the product for Triple Point and run the team internally, now managing just close to 100 million under management in venture as a strategy.
What sort of companies are you looking to invest in?
Early stage, as I mentioned, B2B technology. Can be either pure software, could be tech-enabled services. We're seeing a lot more of that actually in the last year or two. Really focused on three key elements when we're building the portfolio. Firstly, it's going into businesses when they have less than £1 million of revenue, principally because the returns profile of those businesses reflects better, we believe, on the way the UK works. If you look in the UK, over 60% of businesses exit for enterprise values of 50 million or less. Going in slightly earlier means that you have the ability to invest in the same businesses as many of our peers, but deliver slightly higher returns on a per investment basis. It does come with added risk, obviously going slightly earlier. We mitigate that with diversification. As I mentioned at the beginning, more diversified than many of our peers for the amount of AUM we have. And that's very deliberate focus. The idea is that we are delivering on an individual company basis, higher risk, higher return, but leveled out across the portfolio, a similar overall product to what people would expect done in a slightly different way.
So can you give me some examples of recent investments you've made?
Yeah, absolutely. For example, one we made just under a year ago, Treefera. It's a business that's focused on monitoring carbon sequestration of forests. It's actually become a very large market, as people would be unsurprised to know, as you see people trying to reach net zero, whether that's through changing their operations or carbon offsetting. It's very hard to monitor how carbon offsetting works, and Treefera is a key component of that. Since we invested, they've actually grown their revenues 6 times. So the business is looking very healthy. That's one business that we recently invested in. And another is Heat Geek that we invested in around a similar time. Heat Geek's really focused on delivering the training and qualifications for engineers who install heat pumps. Obviously, heat pumps are going to become a fundamental linchpin in us reaching net zero as an economy, principally because the gas boiler, which is something that's been quasi-subsidised in the UK over the last 40 years, is very energy inefficient. But in order to install a heat pump, it requires sometimes re-engineering of the way a house is insulated. It requires schematics for where you're going to put it. And effectively, the Heat Geek system, alongside its network of installers, is the largest, one of the largest, over 30,000 installers that can provide the big six and other energy providers with the ability to deliver installation for heat pumps at scale. And that business has similarly seen material growth around this trend that we're seeing, that is the market has to evolve in order to deliver on these net zero promises.
Very interesting. Now, can you talk to me about some of your more established companies that you've had in the portfolio for some time?
Yeah, exactly. I mean, one business that is worth mentioning, which I think we may have mentioned in the last couple of years, is Scan.com. We invested at the seed stage, as we do often in our strategy. Very quickly, within 2 years, it did a Series A and has just completed a Series B. The business went from a very modest 8-figure valuation to a robust 9-figure valuation in that time. The business is focused on managing medical imaging inventory, so MRI scanners, CT scanners around the UK and now in the US. The idea is to deliver efficiencies to make sure that people on waiting lists are moved to areas where there's free capacity. It's used by private insurers as well to make sure they're monitoring the private capacity. It's really become an infrastructure layer of sorts within the imaging market. So that's one business. And a second business that has been progressing quite well over the last couple of years is Modo Energy. In fact, since we last sat down to speak, they completed a £10 million Series A led by MMC, friends of MMC. Modo is focused on the battery energy infrastructure data market. So thinking that batteries are going to become the asset class of the future, or one of the asset classes of the future. The question is why? Well, the reason is that intermittent energy sources like solar and wind require batteries in order to provide constant energy supply, and people are buying those battery assets and holding them as fundamentally infrastructure plays or real asset plays, and they need the data to monitor the performance of those batteries. It's quite hard to find that data, historically done by individual consultants, and Modo have delivered a platform that is one of the only digital offerings for forecasting and data management in that space, have been growing really with the trend internationally. Founders now have recently moved into the US, now living there themselves, and the business continues to go from strength to strength.
And do you get involved in these companies?
Oh, of course. I mean, you can't invest in the seed stage without getting involved. I think all of us are on multiple boards and spending a lot of time with the companies, developing their strategy and thinking about how they can grow. It's been an interesting market the last few years. It hasn't been the easiest market, as we've seen since 2020, interest rates going up. It's meant that founders have had to take a much more considered approach to the way they run their businesses, and we've been right there trying to help them. We, alongside investment professionals, have an advisory committee which is replete with founders and entrepreneurs who've done it before, mainly because it's one thing to speak to an investor, it's another to have really spoken to someone who's sat in your shoes. For example, Christian Fays, who founded LendInvest, he's one of our advisors, helps out with our portfolio companies. Charlie Dellingpole, who's one of the founder of Comply Advantage, he's also one of our advisors. Henry Carlton, another twice exited entrepreneur, sold businesses, software businesses in the healthcare space. So we are really delivering a network of advisors and supporters alongside investment expertise to the portfolio to help them grow. We, of course, also have a platform with discounts, all sorts, for our portfolios, for example, AWS credits. But really, I think the real value comes from the operators and understanding how they did things themselves, so that founders can not make the same mistake others did before them.
And it hasn't been around for that long a time, but have you had any exits yet from this VCT?
Yeah, it's an interesting one because we go slightly earlier than other VCTs, and that means that we expect the hold period to be slightly longer. Our hold periods are 5 to 10 years, I'd say, on average for an individual portfolio company. Does mean the next 5 years are quite interesting because we're over the 5-year mark, so people coming in now may see some exit action there over the next few years. We haven't had any exits since we last spoke, but we have had 2 exits, profitable exits, since we began. One in 2022, which was credit kudos to Apple, and a second in 2021, which was Depto sold to Greed. We have had 3 unprofitable exits. Really important things, actually, because when something's not going well, being able to recover some of the capital is key for minimizing downside. And so we have done those. In fact, we've had one exit like that in the last year. But we don't consider those exits in the conventional sense.
And have you had any outright failures?
Yeah, we've had 2 failures outright. I would expect the failure rate to be slightly higher over time, given we go earlier. Initially, the benign markets of sort of 2020, 2022 and 19 were able to support businesses that are having problems. We had a couple that go at the wayside. But but many continue to grow, just maybe don't grow at venture scale. We can still support them. They can still deliver return and value for the portfolio. They're not going to be the fund returner that we'd be typically looking for in each new deal we're doing. So we haven't had the failure rate we would expect. We normally model up to a 50% failure rate, but it's still under 10% at the moment.
So just for viewers, it is risky, but yes, but that's why you get the tax relief.
It's risky at an individual investment level. At a portfolio and product level, it levels out because of the diversification. So if you look at, for example, the NAV total return, it's not looking particularly different to other VCTs, even though the underlying way that we do the deals and construct the portfolio is slightly different.
So Seb, just to sum up, if someone's looking to buy a VCT this year, why should they invest in the Triple Point VCT?
Yeah, I mean, I think the Triple Point VCT, and it's been this way for a few years, is a great complement within a portfolio of VCTs. Where people might choose the NASDAQ ETF or a FTSE ETF, they're ultimately still public markets. In the VCT world, you're all investing in similar assets. And what we do is focus on investing in seed stage or earlier stage businesses, more of them, and are focused on B2B software or B2B tech-enabled services to deliver that outcome, which hopefully means greater returns in the long run because exits are more prevalent in B2B. And so just combining those two elements in particular, it gives you something unique that perhaps other VCTs don't quite offer. It's a different take on the way a VCT is built and constructed and managed today.
Seb Wallace at Triple Point, that's very interesting. Thank you very much.
No, thanks, Alex.
If you're watching on YouTube, please press like and subscribe to the channel for more.